Hello, I'm Chris Pedersen, and this is Stock Watch on Thursday, the 10th of October, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations this week. First off, the big news is last Friday in the United States, they had a huge job report increasing the number of jobs by 254,000. This is extraordinarily large simply because expectations were a lot less. And the worry about a soft landing or a recession has definitely been pushed back. Longer-term interest rates have risen. The war in Gaza and Lebanon is now causing oil prices to rise. This is bad for economies overall. However, it's good for the oil and gas sector. Our markets will continue to rise. This is a fascinating chart on economic growth rates, estimates from 2023 through 2028. The big blue happens to be China. The gray happens to be the United States. You look at this chart though, it says, geez, China is really growing, amazing. This is a concern. But when you take the growth rates and adjust for population, well, the United States on a per capita basis is growing twice as fast as China. The only reason China is strong is because of their large population of about 1.3 billion, whereas the US is around 332 million. Adjusted for that, you get totally different numbers. But it counts having a lot of people, as you can see, because the orange happens to be India, and they're growing at a slightly greater rate than the US overall. On a per capita basis, they're growing at probably about 25% of what the US is growing. China influence in Cambodia. This chart is significant because we live in Asia Pacific, and China is exerting their influence throughout the whole region. This influence of China, well, this is the amount of money they've been pumping into Cambodia trying to gain favor. China is continuing to do this in a lot of countries in our region. This is a concern for Australia. This chart shows the amount of new ETFs issued per year in the United States. It is extraordinary, and it's happening in Australia. This is new asset class that's only going to continue growing. Traditional investing, well, it's very important. You have to do your homework, but if you're looking at it as simple index, an ETF is so easy. However, indices are now ETFs, but ETFs are a lot more than just an index. ETFs also happen to be more style-based, not just index-based, such as growth, income, value, etc. Here are the 7 top electric vehicle battery makers. They're huge. They're 80% of the market. It's worth taking a look at who they are. Adidas versus Nike. Well, this is the war on footwear. Adidas is winning right now. It can change, but it's an amazing turnaround. Global demand for oil. Well, one of the companies I chose to talk about today is a function of this chart. What we see is the big drop and then the big rise is COVID and recovery. But going forward, the red dotted line on the right, well, beyond that is estimates. And what the World Oil Council is looking at is oil is going to continue to have a decent demand. It is not slowing anytime soon. 3 companies today. The first one, Cooper Energy. Code on the ASX is COE. It's trading at just 19.5 cents. This is a 5-year chart, and you can see it hasn't been much of a performer. However, there's a shortage of natural gas in Australia. So let's look at the numbers. These estimates are from Macquarie, and Cooper has a market cap of 550 million. Their price target is 31 cents. So that's a 50% increase from where it's trading now. The revenue growth rate they have for the next 3 years is 12% per annum. The earnings per share growth rate, this is greater than 50%, but to be honest, that's off of an extremely low base. It's really 50% plus, but I qualify it. They don't pay any dividend. That's okay for a high growth company. Shareholder equity growth is 12%. The PE on Macquarie's 2026 earnings estimate of 2.5 cents is only 8 times. The yield on the 2026 dividend They don't pay a dividend, so there's no yield. But that is okay, as I mentioned. High growth companies, smaller cap, it is good to plow their earnings back into their company. Free cash flow is negative right now. However, it's estimated by 2027 to be over 15%. The PE over the growth rate happens to be 0.16 ratio. This is the PEG ratio, and below 1 is good. So what does Cooper Energy do? They're a gas producer in Victoria. They have 2 gas processing plants. One is called Orbust, and the other is Athena. It's an excellent potential. However, natural gas, fossil fuels, there is some risk. This is small cap, so it's susceptible to downturns more than big cap. I rated a buy, but only half weight. Second company today is HMC Capital. Code is HMC on the ASX. It closed last night at $8.74. This is a 5-year chart, and what we see is it spiked up before COVID, came down, is now recovering, and is at new highs. Companies making new highs tend to continue doing so unless acted upon by a negative news story. The fundamental numbers for HMC Capital are from Goldman Sachs. It has a market capital of $3.2 billion. 12-month price target is $8.94. So it's been climbing recently, and it's close to that price target. So don't look at that, but let's look at the growth rates and the ratios. The revenue growth for the next 3 years is 19% per annum, and the earnings per share growth is 12.5% per annum, and the dividend growth is 8% per annum. All are decent numbers. Shareholder equity growth is only 2%. So that's a red flag for me. The PE on the 2026 earnings estimate from Goldman Sachs is 41 cents. This gives it a PE ratio of 21 times. The yield on the 2026 dividend estimate of 14 cents is only 1.6%. It has decent free cash flow at 6%, and its payout ratio is 33%. So what do? They're an alternative fund manager. They have strong growth. They're in real estate, private credit, private equity, energy transition. These are all hot topics right now. This is why they're growing strong. If we have a hiccup in private credit or private equity, well, this company will be impacted. I don't see it yet, but private equity cannot continue to perform as it has over the past decade. At some point, there'll be a turnaround going back to a mean. Exxon Mobil is my third company. Its code is XOM, trades in the United States. It's the largest oil and gas producer in the world. US dollars, it's trading at 122.18. This is as of this morning. 5-year chart, it's had a phenomenal run. It's slowing, but still growing. UBS Estimates on Exxon. It has a market cap, US dollars, of $725 billion. So converted to Aussie dollars, this is over $1 trillion. It's massive. 12-month price target they have is $149. The revenue growth in each of the next 3 years is 13% per annum. Their estimate for earnings growth is 17% per annum. And for dividend growth, they estimate it to be 5% per annum. Shareholder equity growth is only 2%. The PE on the 2026 earnings estimate of $10.89 is only 11 times. The yield on the 26 dividend estimate of 4.24 is 3.5%. Free cash flow is strong at 7%. Payout ratio is 45%. So Exxon is performing extremely well. As I mentioned, it's the largest in the world in this sector. They buy back shares to boost their EPS growth. That is why their earnings per share growth is stronger than the other numbers. What is my view on that? Well, I think it's good policy if you have excess cash flow to buy shares back, because that only enhances your earnings growth, and that is what investors are buying your company for. It has solid revenue growth to substantiate the validity of buying shares. I rated a buy. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au. Direct your questions to me, Chris Pedersen. Hope you have a great week. Thank you for your time.